Today, I want to talk about an important concept that a lot of people use the wrong way.
No.
Hi everyone, welcome to State of the Market. I'm Marc Lichtenfeld. When it comes to technical analysis, moving averages are a simple enough concept.
How hard can it be?
They're a line on a chart that is the average price over a certain period. The 50-day moving average and 200-day moving averages are the most popular.
As if!
On a 50-day moving average, you average the price of days 1 through 50 and plot that point on a chart. On day 51, the first day's data is replaced by the new day. On day 52, the second day is replaced and so on, and each new data point is a continuum on a line so that it looks like this. Now here are the wrong ways some people use moving averages. When the 50-day moving average crosses the 200-day moving average to the downside, it's referred to as the death cross. When it crosses to the upside, it's known as a golden cross. Here's an example of a death cross. The blue line is the 50-day moving average and the red line is the 200-day. Now what this tells you is that the shorter term trend has turned more bearish than the longer term trend. Now here's an example of a golden cross where the 50-day moving average has crossed the 200-day to the upside, indicating that the shorter term trend is more bullish than the longer term trend. Now here is where some traders get it wrong. They take the cross as an immediate buy or sell signal. While a cross of the moving averages does suggest an acceleration of the short-term trend, it has never been proven to work as an automatic trading signal.
What is it? Treasure map?
Now you can see from both of those charts that by the time the crossover takes place, the stocks have had major moves already. That doesn't mean they can't continue to go lower or higher. They certainly could, but it may not be the signal some traders think it is. Instead, watch the slope of the moving averages. When it starts to turn up or down, that's a better indication that the trend is shifting. In the Brookfield Renewable example, when the 50-day moving average starts to turn higher in the middle of July, you could have bought the stock in the mid to high 30s, a much better price than if you waited for the cross. Another oversimplification is to buy or sell a stock when it crosses a moving average. Again, I haven't seen any data that supports this theory. Sometimes moving averages act as support or resistance, such as with the Brookfield Renewables example. You can see that in February, the stock blasted through it to the upside, and then in April, crashed through the 200-day moving average. But after that, the 200-day acted as resistance 3 times before it eventually gave way and the stock went higher. Each stock and its relationship with its moving average is different. So if you see a stock that constantly gets stuck at its moving average, then a breach of that moving average may be a good trading signal. But many stocks don't behave that way, so don't blindly trade a stock just because it broke through its moving average.
Oh yeah!
Now, many investors want technical analysis to be an exact science. It's not. But a moving average can give you a strong indication of the short and longer term trends to help you make better decisions. Use them that way rather than as an absolute sign whether to buy or sell. If you want to learn about the exciting charting technique I'm using to play micro bounces in this difficult market, click below for my free webinar.